Friends, myself Subrata Mukherjee and I am working as Associate Professor in Mahadevananda Mahavidyalaya, Barrackpore. Today I am going to discuss about cost volume profit analysis. When we are learning about the cost volume profit analysis, we have to know about this graph. On x-axis, we keep the quantity or the output, and on y-axis we plot sales and cost. So irrespective of the production, we have to incur some cost which is fixed in nature, denoted by FC or fixed cost. Variable cost per unit is constant, but the total variable cost increases with the increase in output. The sum total of fixed cost and variable cost gives total cost, denoted by TC, and this is the sales line. So the intersection point of sales line and the total cost gives the break-even point. The angle made by the sales line and the total cost line is denoted by theta, known as angle of incidence. At break-even point, the firm earns no profit or no loss. So to the left side of this BEP level is the loss zone, and to the right of this BEP line it is profit zone. At any sales level, the difference between the sales and the break-even sales is denoted by MOS or margin of safety. Now let us discuss about the income statement. Sales less variable cost gives contribution, less fixed cost gives the profit. Now I discuss all the formula, and while solving one problem we will discuss in detail the meaning of each. The first one you have to remember is PV ratio or profit volume ratio. This is equal to contribution by sales into 100. PV ratio can also be calculated by change in profit by change in sales into 100, or 1 minus variable cost ratio. Next is BEP, that is break-even point, and break-even point is calculated in units as well as in amount, that is rupees. So break-even point in unit is calculated as fixed cost by contribution per unit, and break-even point in rupees is calculated as fixed cost by PV ratio. Next, expected sales. Expected sales in unit is equal to fixed cost plus expected profit by contribution per unit. And expected sales in rupees is equal to fixed cost plus expected profit by PV ratio. And the last one is MOS or margin of safety given by sales minus break-even sales. That is break-even point in rupees. And MOS as a percentage of sales is given by MOS by sales into 100. So this formula I have presented in one screen. Number first is the PV ratio. The next is BEP in unit and BEP in rupees. Third is expected sales in unit and expected sales in rupee. And the fourth one is MOS and MOS as a percentage of sales. Now we will explain in detail each formula which is used here while solving the problem. Problem number 1. A company produces a standard product. The selling price is rupees 10 per unit. Fixed cost are rupees 24,000 per annum and variable costs are expected to be rupees 6 per unit. How many units must we make and sell before we begin showing a profit? Number B. How many units must we make and sell to show a profit of rupees 10,000? So in question A, part A, we have to calculate the break-even point. The point after which we will be able to have a profit. And in question B, what is the expected sales in order to have an expected profit of rupees 10,000? So selling price per unit given as rupees 10 less variable cost per unit rupees 6. So contribution per unit is equal to rupees 4. Given fixed cost per annum is rupees 24,000. To calculate BEP in units is equal to fixed cost by contribution per unit. So fixed cost is 24,000 and contribution per unit is 4. So this gives 6,000 units. And BEP in rupee or amount is equal to 6,000, that is BEP in unit into selling price per unit or rupees 60,000. So this is BEP in units into selling price per unit. The next is the expected sales. Expected sales in units is given by fixed cost plus expected profit by contribution per unit. So fixed cost is 24,000 plus expected profit 10,000 divided by 4, this gives 8,500 units. Similarly, expected sales in rupees, expected sales in rupee is equal to 8,500 into 10 is rupees 85,000. This is also the same. We have calculated, that is expected. This is expected sales in unit and this is the selling price per unit. What does this signify? It means that if we sell 8,500 units, we will be in a position to earn rupees 10,000. You can check it yourself. 4 rupees is the contribution per unit. So 8,500 unit into 4, total contribution comes to 34,000 minus fixed cost 24,000, then profit will be rupees 10,000. Problem number 2. Conditions prevailing in a firm stood as under: sales rupees 10 lakh, fixed expenses rupees 2 lakh, profit rupees 2 lakh. From the above information, work out PV ratio, break-even sales point and margin of safety. What should be the sales to earn a profit of rupees 4 lakh? In this type of problem, we have to make the income statement first. So it is given sales rupees how much? 10 lakh less variable cost, we don't know, contribution not given, less fixed cost. So we have a fixed cost of rupees 2 lakh, this is given, and the difference of contribution and fixed cost gives the profit, which is given as rupees 2 lakh. So what is the amount of contribution? You have to sum total the profit amount and the fixed cost, which is equal to 4 lakh. So you need to sum up these two. And what is the amount of variable cost? Simple. 10,000 minus 6 lakh gives 4 lakh as contribution. So this is the income statement that you have to prepare for this type of problem. Now one by one we will solve out the PV ratio, break-even sales, MOS and MOS as a percentage of sales and the expected sales. PV ratio is calculated as contribution by sales into 100. Your contribution we have calculated from the income statement as 4 lakh. Sales rupees 10 lakh into 100, so is equal to 40%. Next is BE sales. BE sales or break-even sales is equal to fixed cost by PV ratio. Fixed cost is rupees 2 lakh by 40% is equal to 5 lakh. Next is margin of safety or MOS is equal to sales minus break-even sales. 10 lakh minus 5 lakh is equal to rupees 5 lakh. And MOS percentage means MOS as a percentage of sales is equal to 5 lakh by 10 lakh into 100 is equal to 50%. The last one is expected sales to earn expected profit of rupees 4 lakh. So expected sales is equal to fixed cost plus expected profit by PV ratio. So 2 lakh is the fixed cost, expected profit is 4 lakh, divided by 40% comes to 15 lakh. So if you sells 15 lakhs rupees, then you will be able to earn rupees 4 lakh. Hope all of you have understood the problem that I have discussed today. Thank you.